Hey everyone, I'm Jeremy Szafron and this is Kitco News. If you haven't already, don't forget to subscribe to our channel, of course, for the latest. Now this year, the oil market has seen remarkable volatility. WTI currently stabilizing around $85 per barrel after significant fluctuations. Now several factors are driving this instability. The current geopolitical tensions in key oil-producing regions of the Middle East have sparked concerns over supply disruptions. And additionally, ongoing adjustments in global economic policies in response to inflationary pressures are varying demand. Recovery rates from the pandemic obviously continue to impact oil prices as well. Now, this has resulted in a cautious trading environment with investors closely watching for any signs that might indicate future price directions. And our guest today, Mike McGlone, is a senior commodities strategist at Bloomberg Intelligence. And he notes that extended petroleum future hedge fund positions might indicate that we're nearing a peak similar to last year's $95 high a barrel. Now, with significant implications for other markets, including, of course, gold, bond yields, and equities. We want to talk to Mike and break this all down. Hey, thanks for coming and joining us, of course, today.
Thanks for having me on, Jeremy. First, I like to make it clear, I start with my view. I think oil's more likely to go down towards 50 than up towards 100. That's WTI at 85 as we speak. And you mentioned managed money net positions, futures, hedge funds basically are about 15% long in all petroleum products of open interest. And that's right near where the market peaked last year, around 95. So you see that tilt positions are as long as they were about 10 barrels higher last year. And there's a good reason to be long. I mean, we have the number one reason oil's going up is because of geopolitical tensions. Everything else is just a matter of time. I think oil does what it normally does and tilts lower. But that's it. I mean, we have some significant wars going on, particularly in the Middle East, and now everybody's worried about the next Israel response to the Iran attack. And the way I see it is you need sustained supply disruptions and geopolitical risks. Otherwise, oil's going to do what it always does, and that's drop towards its cost of production. In the U.S., that's around $55 a barrel. And just giving examples, natural gas has already done that.
Mm-hmm. Yeah, absolutely. Oh, I'm curious. So, I mean, you're calling for $50 oil, but could we see sustained higher prices if this conflict keeps happening?
Sure, it'll just make it go to 50 later. That's the problem. That's the unique thing about oil. Let's remember, the oil is the world's worst performing commodity. It's a major commodity. If you compare it to very broad commodities, gold, Bloomberg Commodity Index over time, 50, 20, 10 years, it's usually the worst performing. And it's the most autocorrelated. When it goes down because it goes up, and it goes up because it goes down. And it's partly because of the elasticity of supply is the greatest ever, and demand is too. But if you add U.S. and Canada together, the excess of supply of the U.S. and Canada is near 6 million barrels a day. When oil peaked in 2008, that was a deficit of 10 million barrels a day. So that's the key reason oil's going down. And every single day that oil stays at these levels above 55, it just accelerates those trends. And then here, I mentioned 6 million barrels a day, but if you also compare what OPEC's spare capacity is, which is about a 10-year high, it's running near 7 million barrels a day. So the outlook for crude oil to me is very poor, particularly when you look at the macro. The macro is, I like to look at, key thing that's really, remember about oil, it's very highly correlated to the U.S. stock market. U.S. stock market is quite expensive at these levels. And it's the risk of some reversion. A key thing I like to watch is global bond yields for an idea where global commodities are going. If you look at global bond yields, so we'll start with China. Its 10-year note yield is about 230 basis points below the U.S. That shows a global tilt towards deflationary recession. And crude oil, natural gas, rising gold are picking up on that.
Yeah, interesting. Elaborate a little bit more, Mike, for me on how central bank policies, particularly those related to inflation, are affecting oil prices. Like, break this down for the audience, how those two are in tandem.
Well, I don't think it's coincident, the fact that we had record highs in the stock market this year and crude oil bumping up near the upper end of the range, sticky inflation, and Federal Reserve rate hike expectations diminishing. I mean, there's no reason to hike rates when oil's bouncing and stock market's at record highs. So that's exactly what happened last year when crude oil bumped up to near 95. That's when the 10-year note and the 2-year note yield peaked around 5%. And then crude oil dropped to almost 60. The low was actually 64, but 70 or later in the year. So to me, there's that tilt. And that's part of the lose-lose for crude oil bouncing. If it spikes on risks for geopolitical reasons, that just pushes the whole world towards recession. But if it does what it normally does, once those tensions are alleviated, it goes down to a very cheap price. And always has worked that way. I look at one example, when people say wars are good for crude oil, it's the opposite. You look at the Iran-Iraq war, crude oil bumped up to near 30. That's right about when futures started trading, then bottom in 1986 around 10. Same with when Iraq invaded Kuwait, crude oil bumped up from 20 to 40, and the low in 1998 was around 10. In the last actually since 2008, it's made lower lows and lower highs, and the lows have been near 40. I expect that to continue. We have an example of that happening from natural gas. So the key thing I like to say is for crude oil to keep going up here, it needs some form of sustained supply constraint, the global economy to take off, and the U.S. stock market to keep going up. All that is unlikely events. I think it's more likely to do what it always does, get below its cost of production, which is the U.S., shut off that excess supply, increase the demand, and then put in a better bottom. Right now, I think this bottom we put in last year around $64 is not sustainable.
Yeah. I mean, what's the stronger dollar and declining equities doing for commodities right now?
There's a key thing is the stronger dollar is part of the bearish factor for crude oil and most commodities, most notably broad commodities, most notably gold. But what's driving the dollar? And the key thing that's been driving the dollar since about 2011 is the outperformance of the U.S. stock market versus the world. And there's part of the lose-lose. At some point, there's going to be a little bit of mean reversion. The U.S. stock market versus the MSCI ex-U.S. index is the highest ever. I mean, it's a little bit dicey. And you'll have things like inverted yield curves that used to matter. And the key thing I'm worried about is the rest of most of the top countries in the world, I mentioned China, have bond yields that are much lower than the U.S. That shows that tilt towards deflationary recession. So strong dollar is part of the lose-lose for commodities because what's it going to take for the dollar to drop? It's probably going to mean a weaker U.S. stock market. It means everything goes lower.
Yeah. If we see this sticky inflation sticking around, say that 10 times, what do you think is going to happen to the commodity market in the immediate effect?
Well, commodities are part of the sticky inflation. The bounce in commodities was at least crude oil. And then I like to point out the world's most significant source of heat, electricity, and fertilizer, that's natural gas, has dropped to the same prices as first traded in 1990 in futures. So it's somewhat related, but the sticky inflation, I think, is mostly right now the wealth effect, and it's from the stock market. But remember, the trajectory is inflation is clearly heading lower. It's stabilized a little bit. The question is, does it bounce, or does it just take a little pause and head lower? I'm more likely to bounce and heading lower, and I see that, like I say, an inverted curve, yield curves, and most other bonds in the rest of the world. And the key thing I'm worried about, Jeremy, as you look at U.S. VIX volatility index, it's extremely low. The 52-week average of the VIX is just around below 9% if you subtract out the T-bill rate. So that low volatility, high rates is really subject to some reversion upward in volatility, downward in T-bill rates, which is what I think is going to be driving this next leg lower in disinflation trends, which I think is clearly going to head towards deflation. And there's one key pillar still holding it up, and that's the U.S. stock market. And that U.S. stock market looks like it's finally putting in a decent peak that might last a while.
Yeah, starting to see a little bit of cooling off. Your latest note, you talked about your analysis, and you indicated that the hedge fund positions might be signaling a peak in oil prices, of course. Here you're talking about $50 oil. Explain the insights that these positions provide and how they might predict, the movements in the future for us.
So what I use is the petroleum futures. So that's crude oil, both Brent and WTI, and the distillates, and I divide them by open interest. To me, that's the best way to do it. It's been a very good, robust measure, and I just look at last year. I put out a sell signal when I was at $95 a barrel because these positions bumped up to around 15% of total open interest was net long crude. It's just a classic examples. People were just too long. It's a lesson we learned in the trading pits. And now that's the same thing. We're right about 14.6%, right near that peak, and we're bumping up against 85. So positions are way too net long, which means long liquidation is just going to take a little spark. And that's the point is every day that goes by that we don't have a major reason for crude oil go up, it's more likely to drift lower. And at some point, I think the risks are it just goes back to its cost of production, like you mentioned, which is around 15. What typically happens is commodities is it's the lessons of the high price cure. We're in the back end of the high price cure. Up to 2022, we put in a peak around 130 WTI, which was below the peak in 2008. And now we're heading lower and bouncing, and we haven't reached that low price cure. Now we got pretty close in corn, got around 4. We are there in natural gas. That's what usually happens. And the key thing also is the macro is typically you take, that's the commodity cycle still on a downward bent in my view. And typically you take a decent lag to interest rate eases before you can get the macro economy to pick up. But we haven't even started that except in one economy, and that's China. And China's in a pretty severe, I think, deflationary trend. And once the rest of the world starts tilting downward, we're going to see that bent towards global deflation, which is completely logical, natural after the significant pump in liquidity and pump inflation we had to the peak in 2022. That's still dumping if you look at things like U.S. money supply, and interest rates in this country are still very high.
Right. Yeah. So, I mean, have we hit a top? I mean, you've discussed the relationship between oil prices and other markets like gold and stocks. Explain that a little bit. I mean, we've got gold all-time highs, WTI at 85. Where are we at?
So I like to compare the gold to the S&P 500. I'm sorry, gold to the stock market. So right now it's about 27 barrels of WTI of gold, and that trajectory has been upward since the bottom in 2008. So I fully expect it's going to get to near 60 barrels of WTI to gold, which would be, if you put benchmark it, maybe around $50 a barrel versus $3,000 an ounce in gold. To me, that's the next key level. Another good way to look at gold is if you just take gold in per ounces and put it on the same scale as the S&P 500. You can go back to 1926 on that. And certainly since the U.S. came off the gold standard in August of 1971, it was a Sunday night, August 15th. Every time that gold gets a significant discount to the S&P 500, it's more likely to revert backwards, particularly if you head towards recession. And right now, gold is still at a pretty significant discount to the S&P 500. And we might be tilting towards this recession. Remember, the pendulum swung towards too far to the pendulum to a recession last year. We didn't get it. And now it's swung too far towards no recession, which means I think it's going to just swing back a little bit. To me, that's what gold's doing. And I fully expect gold to continue to rally and do what it normally does, and crude oil to do what it normally does, to get pretty cheap before it can really put in a decent bottom.
Right. You know, looking beyond immediate market conditions, what are some long-term trends that investors should be aware of in this market, that currently affect global economic stability?
Well, I presented at the Money Show last week, and I showed my whole outlook. I came right on after Jim Bianco came on. He said U.S. interest rates are going up, and I said, no, they're going down. And here's one key. I showed the one key chart that I was the most fearful of, and that is just overlaying gold and the S&P 500, that per ounce price of gold, on the same chart. So I think it's simply going to revert maybe towards $3,000 an ounce. So to me, that's the macro that matters. And that's the number one thing I think that's going to really kick in. And on a chart pattern and a big picture, it means nothing. But now, if you were to mention that to people who are so overweight long the equity market, it would be quite significant. So that's what I'm concerned about, is people have forgotten the normal nature of markets to mean revert. The most powerful force in markets is mean reversion. And is there a good catalyst? I like to say yes. We have the number one factor right now is this shift in the world order that started with President Xi and President Putin's unlimited friendship that tilted the scale towards favoring gold, and it pumped up commodities initially that are dumping, and it really shifted the world away from China. And to me, that's part of it. And now China, to me, is in a very similar situation that's very akin to the way I see when Japan peaked in 1990 and the Soviet Union peaked around the same time. The whole economy is just doing what a normal, rapidly advancing emerging market does, and it's reverting, which means severe deflationary forces. And it's showing up, I think, in yields. The 10-year note yield in China is 2.30 or so. In the U.S., it's 10-year notes about 4.65. That's not a sign of, when your bond yields are that low, it's not a sign of demand pull, inflationary forces kicking in. And if the government's buying them, it's indicating how bad things are.
Yeah. And I mean, the central banks over there are buying a lot of gold too. So is that what's sustaining these levels?
That's certainly part of it. I like the quote from the World Gold Council. They use the word colossal for central bank buying of gold. And the way I like to say it, when the deepest pockets on the planet can actually print fiat currency are buying gold, you probably should go with that trade. So to me, that's part of the number one driver for gold. And I like to point out what's really unique is, I think the number I did recently was for the last 2 years, almost 3 years, the total buying in central banks was around 90 million ounces. And the total selling in gold ETFs has been around 30 million ounces. So central banks are buying about 3 times that ETFs been liquidating. And that's what I think is really significant, Jerry. When you see gold advancing, it's unprecedented that gold ETFs have dropped about 25% from the peak in 2020, yet the gold price has gone up almost 30% from that. I've never seen that kind of divergence. So the way I see it is at some point, those gold TF outflows are going to shift to inflows. And that's just part of the bullish signs I see for gold. Now, yes, gold is going to have some back and fill. It's getting a little expensive here, just around 2,400. But the key question is what's going to take for Western investors to tilt back in favor towards gold? And I think the number one thing is just a little bit of disdain for the U.S. stock market and yields starting to decline. See that tilt? At some point that will happen. At some point as volatility picks up. And at some point that inverted yield curve that we all learned used to matter. The quote I like to use is stuff that used to matter will start mattering. It's just going to make it as frustrating as possible. And that's what gold did. Gold, I started talking about $3,000 gold about 2-3 years ago, and it just kept bumping up about 2,000 and making me look like an idiot when it dropped down. And finally, it's as that smile on your face shows, it's just going the way that a lot of us expected. But it has to cause the most pain before the gain.
Yeah. And do you think that this is something that's this year, Mike? I mean, what's the short-term forecast? You think it's going to hit 3,000 this year?
I was expecting to do that, but as a strategist, putting time and price together is probably not a good idea. My main quote is, I think 2,000 resistance is now key support. It's just a matter of time it gets to 3,000. Let's update that as we move on. And I don't know how long to say, but the key thing, I think the key trigger for gold to accelerate this rally is when investors start realizing that we are going to have a legitimate, elongated stock bear market, the kind of things that used to happen. After you get too expensive. And that's just normal mean reversion.
Yeah. Everything that goes up must come down, they say.
Well, that's true. And sometimes in markets, most of the time in markets, it's very true in commodities. It's one thing I like to point out. It's one of my favorite technical patterns that work out well in the stock market, that it's going to go up because it went up. And the commodities, it's almost always the opposite. It goes down. They go down because they go up, with the exception of one main commodity, and that's gold. Is the most enduring, best performing commodity over time.
Interesting market, to say the least. Mike McGlone, Senior Commodities Strategist at Bloomberg Intelligence. Hey, Mike, thanks for coming on and breaking this down for us today.
Thank you, Jeremy. I enjoyed it. Talk to you later.
And I'm Jeremy Szafron. For all of us here at Kitco News, thanks for tuning in. Be sure to like and subscribe to our channel. We'll see you next time.